Gives me great pleasure to bring on board Viktor Shvets, Head of Global Desk Strategy at Macquarie Capital. Victor, fantastic to have you on ET Now. Season's greetings from Team ET Now, and thank you for joining us. Victor, let me start with a very basic question. What is your view of the world, given that there are so many permutation combinations which are there? US interest rates are likely to go down. China is stimulating their economy. There is a problem in Middle East, and yet India seems to be slowing down. So there are a lot of trends within trends when it comes to the global setup.
Well, my view of the world hasn't changed that much over the last 4 or 5 years. Effectively, the way I look at the world as in a twilight, we no longer have recessions, and we no longer have recoveries. There is nothing to recover from. We live in a twilight, somewhere between recessions and growth. Global growth rates are getting shallower, and IMF is correctly highlighting that we're growing 50, 100 basis points less than we used to. But at the same time, we don't have the bad things. We don't have spikes in bankruptcies. We don't have spikes in bad debts. So in other words, my view over the last several years was that we have largely eliminated economic and capital market cycles. Now, do we pay a price for doing it? Of course we do. One of the things is accumulation of inefficiencies, much shallower growth rates, much more volatile neutral rates. That's part of the reason why central banks have to go from being dovish to hawkish and back again at an incredibly fast pace. We exited a lot of the risk to outside the system, outside economic systems, I should add. So in other words, it's much more in the politics, in polarization, in geopolitics. It's much more in climate. It's much more in healthcare. And those shocks regularly interfere with our screens. So to speak, if you just look at your screen, you're playing computer games. It's not real. But now and again, real life really interferes with the screen. But a lot of that interference comes not from economic cycles, not from capital market cycles, but come from outside the system. Now, if you think about it, that's actually not a bad climate for assets, in a sense that we don't have bad things, no recessions, no major recoveries, but we continue to grow. Interest rates will be lower, liquidity will be higher, and that's sort of a Goldilocks for generically defined asset classes.
Peter, are we moving pretty much in line with what we'd moved in the first half of last decade, which is that US economy came out of GFC crisis and we moved into many years of this Goldilocks scenario? Because if you are of the view that the Goldilocks scenario is here and liquidity is abundant and inflation is manageable, so are we in a low inflation, high growth and abundant liquidity setup for many, many years now?
We are. The only difference between, call it 2010, 11, 12, and today is that we have a lot more black swans. So in other words, the consequence of global financial crisis was that people and countries no longer agree on what is the right economic, political, social, or business model. If you no longer agree what is the right thing to do, then inevitably you have clashes. You have clashes within the countries, and that's polarization and highly unpredictable electoral outcomes. You also have clashes between the countries, and that is your rising geopolitical risk. So compared to 2010, say 2010, 11, 12, 13, and today, the climate is a lot more uncertain. But the basic backdrop is the same. We're avoiding recessions. We're not really strongly recovering. Growth is fine. Interest rates will come off. Liquidity will increase.
So when you say that we are in a Goldilocks scenario, does that mean that all asset prices, they will continue to march up? Because if we look around, from financial markets, which is equities to Bitcoin to gold, everything is at an record high. US markets all-time high. With the exception of China, all other emerging markets are at an all-time high.
No, not at all. The fact that you have a Goldilocks assets doesn't mean that all assets go up. Federal Reserve or any other central bank doesn't really mind if you personally lose money. That's absolutely fine. So they don't even mind if one asset class goes down, but if another asset class goes up. What they cannot tolerate is systemic risk. So if you think of systemic risk of repo market crisis in September 2019, if you think of systemic risk of pandemic in 2020-21, if you think of systemic risk of Silicon Valley Bank in 2023, that cannot be allowed to progress. And so it doesn't mean all asset classes go up. All it means holistically as an asset class, you are going to be higher. Now, the question is who is going to do better and who is going to do worse? India is perfectly positioned geopolitically. So is the US. Europe is a cauldron of all social immigration and geopolitical issues you can imagine. You also would like to have wide waterfront of investable assets. US clearly has the widest. Japan has very wide. In emerging market universe, India has the widest universe of stocks and companies that you would like to invest going forward. You would like to have some degree of certainty on commodities front. Again, some countries satisfy, some do not. So if you do the sort of what you would like to see, US satisfies everything apart from social. And that's why I always say only Americans can kill America. And maybe they will, but that is the only point of vulnerability. If you think of India, again, satisfies almost everything apart from commodities and social. If you think of Europe, for example, satisfies almost nothing. If you think of Japan, is in between. The interesting one is China, because it actually does satisfy a lot of criteria that you would like to see. It's really the conundrum of income and investment and savings, as well as political and geopolitical picture of China that really precludes it from coming to the fore. So to me, I'm still very much in the case of, from a macro point of view, choose the countries, choose the markets which are most likely to prosper in that climate.
So on the macro analysis, how much weightage would you pay to debt? I'm talking about sovereign debt because post-COVID, when economies were coming back, we were told that central bankers are doing something which will haunt coming generations, which is that they're bloating their balance sheet, they're borrowing from the future, and something which is not going to sustain and perhaps could lead to a blow up of a lot of sovereign debt.
Yes, and I think the market also starting to differentiate as well, because not every sovereign debt is made equal. Remember, I've just mentioned monetary sovereignty. You issue, you use, you borrow predominantly in your own currency, mostly from your own citizens. Now, in countries like that, there is no sovereign debt because essentially we lend and borrow to each other. By repaying the debt, you're not improving national well-being. You're not improving national wealth. And therefore, you're not really settling any future generation with unpayable debt. But if you are Argentina, or if you are Venezuela, or if you are Turkey, or if you're South Africa and many other countries, that is not true. You're still living in a world where the debt must be repaid. It's still live in a world that you're at the mercy of the global markets and what the global markets can do to you. So what the market is doing is basically two or three things. Number one, recognizing that public sector debt is not crowding out private sector investment. If anything, public sector debt actually co-opts private sector investment. And that's been the story of the last 10 or 15 years. Secondly, they recognize that different countries are made from different cloth. And in many countries, sovereign debt is really a fiction. Classic example is Japan. If you think of Bank of Japan, they're sitting at over 100% of GDP on a Bank of Japan balance sheet. What will happen if you reincorporate Bank of Japan back to Ministry of Finance? That debt will evaporate. So in other words, who owns Bank of Japan? People of Japan. Who owns Ministry of Finance? People of Japan. When you do consolidation of the group, do you eliminate transactions between subsidiaries? The answer is yes, you do. So essentially, that debt does not exist anymore. The only reason it exists because you're treating Bank of Japan as a separate entity from Ministry of Finance and the rest. But as I said, there are countries where those considerations do not apply. But the good news for the United States and Japan in particular, that it certainly does. And therefore, there is no such limit of saying, well, it's 100% of GDP, 120%, 130, or it's 220% as it is in Japan. Those limits don't really exist. The only other thing to say is that clearly India does not fully fall under this criteria. But because of massive liquidity domestically, and because of capital controls that India is exercising, and because of a declining external vulnerability that India has experienced over the last decade, they come close to having a very high degree of monetary sovereignty.
Productivity gains have always been a function of innovation and invention. For example, what steam engine did to Europe, how internet in a sense really had a huge impact on the US economy. Given that we are on a brink of an AI revolution, what are your views on India and China, their preparedness and their adaptability from this entire AI productivity cycle?
My view is that we're probably at least 5 to 10 years away from artificial intelligence having any meaningful impact on productivity growth rates going forward. So if we start looking sometime in 2030s, I think there is a high probability that there will be a jump in productivity, but not right now. And the reason is very simple. In order to accommodate the new technology, you must change how societies function. So one of the things McKinsey did when they estimated potentially $10 or $15 trillion benefit of artificial intelligence, as a throwaway phrase, they said, but certain people would need to be retrained. Certain professions will disappear. Yes, they will. And so how are you going to maintain aggregate demand? And the answer is we need to think of the policies. What is the role of universal basic income guarantee? What is the role of the public sector services? How do we finance public sector as we go forward? What is the role of modern monetary theory or central bank in affecting that stuff? How do we change education and skilling institutions to accommodate this new world? So McKinsey is absolutely right. There will be benefit. But before you reach this benefit, you've got to put policies in place to maintain aggregate demand as societies change and as business models change to reflect artificial intelligence. I mean, just very quick example, investment banking. Prior to ChatGPT, investment bankers could have been hiring 500 graduates to end up with 50. Now they're probably hiring 250 to end up with 25. Next year, they'll be hiring 100 in order to end up with 10. And then they hire 50 in order to end up with 1. That will be the impact. It's not that you're replacing the jobs outright. It's on the margin you need less as you go forward. And so the question is what happens to other graduates who are not there? What jobs would they do? How would they support income as you go forward? So to me, to answer your question, I think AI will be the next stepping stone. I think it will raise productivity from roughly 1% right now to a high level. But I'm not in the camp that it's happening right now, or even that it will happen in the next 5, 10 years. I think it's a longer term process. Who is best positioned? Essentially anybody, as I said, with the right mix of tangible and intangible assets. If you think of the United States, for example, private sector GDP is already around 50-55% intangible and around 45-50% tangible. That's about the right mix of the two that you would require in order to grow productivity. For a country like India, it's different because India is below technology frontier. And because India is below technology frontier, all you need to do is to adopt and adapt the policies and technologies that were already invented somewhere else and tried somewhere else in order to improve your own productivity as you go forward.
Last but one question, and one question specifically about China, India. Since you've done a lot of work and you've compared India and China both, in your latest note, you've also mentioned that it's a hard choice. But if you have to take the clock back 30 years ago, The per capita in China was about $500. Now it stands at $10,000. India's per capita is now currently at about $2,500. Do you think it's a matter of time we could move to 3,000, 5,000, and then eventually to 10,000?
Now, what we're facing going forward over the next 20 years is not a good time for emerging markets to emerge again, just like it was not a good time between 1913 and 1970s. But that doesn't mean there are no countries, because even in those times which were not conducive to emerging markets, there were success stories. It's just as an asset class, you don't have sufficiently conducive environment to do so. But even then, there were success stories. And so the question then becomes whether India, which currently adding labor, capital, and growing productivity at the same time, if you do all of those three things, you allocate capital efficiently, which means ICA rate, incremental capital output ratio, do not jump. It means return on equity capital improves. It means cash flow increases, external vulnerability decreases. How long can India continue on that path? As I said, when everything is growing and the world is growing and the world is liberalizing, it's easy for a lot of people to do that. But that's not what we are facing. Global growth rates will be constrained, trade will be constrained, capital flows will be constrained, the role of tangible versus intangible capital will change, manufacturing plants will be disappearing, supply and value chains will be atrophying. It's going to be a very different world. So in that world, how long can India go on with those numbers? And the answer, at least for now, that is likely. But at the end of the day, what India would need to address is a very low domestic productivity. It's all about agricultural productivity. It's all about retail trade, wholesale trade, utility, construction, financial services. In other words, non-tradable sectors is where productivity must increase. And efficiency of capital utilization needs to get higher. So the way I look at it, over the next 5 years, there is enough momentum that India can grow at 6 or 7%. I think 8% is not attainable, but 6 or 7 is. And at that level, double-digit nominal GDP is conceivable. Beyond that lies harder to tackle areas. As I said, it's your water supply, uncertain monsoons. What crops do you plant? What crops you don't plant? How do you deliver them? Why you have 600, 700 million people in agriculture? Can you relocate them out of agriculture? Do they have a skill base to be able to relocate? How do you develop manufacturing? How do you tackle very politically sensitive areas, which is domestically oriented? So there's a whole range of issues, but I feel for the next 5 years at least, somewhere around 6 or 7 is achievable, which is, as I said, double-digit type nominal. Now that should get India to a higher level. When you say, can India reach $10,000 or $12,000? Well, it depends. GDP per capita. Well, it depends on the next leg, and that is a domestic restructuring of India.
My last and the final question is about India. The India romance is all about demographics, a very vibrant young population, which historically has played a very large role in our evolution. We have a very young population. China is aging. US has aged. Europe is known as the sick man of the world. So given that we have a very differentiating young population which is under 40, could that really be the big differentiator for India going forward, the demographic advantage?
Much less than it used to. So in other words, that would have been a very good argument in 1980s, in 1990s, even the early 2000s. That argument is becoming less and less important, primarily because people are less and less important. So the marginal utility of people or humans is declining. And as technology evolves over the next 10 to 15 years, it will decline even more. So you could imagine a situation where having lots of young people is actually becoming more like a Malthusian trap rather than an accelerator of productivity the way it was in an industrial age of the 19th and the 20th centuries. So is it a plus? Yes, it is a plus. Is it a diminishing plus? I think it is a diminishing plus as you go forward. Far more important are educational and skilling levels that those people can achieve and how they reconcile themselves against the information age and how information age changes the functioning of both capital and labor. So in other words, how much tangible capital do you need? How much intangible capital? What sort of labor force you need? Are they formally employed, informally employed? What roles do they perform? How do they grow productivity? Those are more important issues now rather than whether average age is 22 or average age is 40.
All right, Victor, really appreciate your time. So glad you could join us, and thank you for your valuable input.
If you like this video, then like, share and subscribe to ET Now.